Welcome to the Tulane Future of Energy Forum. Please be seated. The session will begin momentarily. A reminder that Tulane University promotes and protects the free exchange of ideas. Freedom of expression includes the ability to engage or not to engage in the exchange, examination, and discussion of ideas. It does not include the right to disrupt the freedom of others. Therefore, we prohibit the physical or virtual disruption, shouting down, blocking, or suppressing of a protest, a demonstration, program, or an invited speaker's right to speak. Please note that disruptions of this nature may result in the removal from the event.
Good morning, welcome to Tulane University. It is my pleasure to introduce our next session, Counting What Matters, Sustainability, Tax, and the Bottom Line. If time allows, at the end of the session, the panel will take questions submitted by the audience. To submit a question, please scan the QR code located on the screen. Please be sure to silence your cell phones, enjoy the conversation, and please join me in giving a warm welcome to our moderator, Professor Gans.
Thank you. My name is Gans Narayanamoorthy, and I hold the Jayne Ritchey Cohen faculty chair in business administration at the Freeman School. I have been an accounting professor for over 25 years now, and prior to academia, I was an investment banker, and I have actually had the opportunity to take an energy company public, in 1995. Back then, of course, sustainability was not on anybody's radar. That brings me to our two experts here. I'll introduce Jeff Hales first. So Jeffrey Hales is the Charles Zlatkovich Centennial Professor of Accounting at the McCombs School of Business, UT Austin. He also holds the Bake Chair in Global Sustainability Leadership, and he's the Executive Director of the Global Sustainability Leadership Institute at UT Austin. Besides being a very rigorous academic, he has published in the top journals in accounting and finance. Jeff also was, I think, one of the founding members of the Sustainability Accounting Standards Board. He served as its chair for a number of years and is currently a member of the International Sustainability Standards Board. So thank you. Welcome, Jeff. Anu Varadharajan is a Director of Sustainability and Taxation at KPMG. She has spent over 15 years in Big Four accounting firms, PwC and KPMG. She deals daily with tax credits and incentives. But we also welcome Anu back to Tulane because for a number of years, she was probably the Freeman School's most popular professor ever. She taught tax here at Tulane. So you will notice that both panelists straddle both the real world and academia, and they combine an ability to know what is happening with the ability to disseminate it very effectively. So I thank you very much for both of you coming here. I'll set the ball rolling. Jeff, you've been with sustainability accounting right from its earliest days. Give us a brief history of how we got here and tell us why it is important.
Yeah, sure. So thanks, Gans. Thanks for having me here and for the opportunity to talk about this. It's a good question. The way I sort of think about the history of the intersection between sustainability issues and the accounting profession, I used to think of this as there being three major periods of time, and then we're sort of like now entering a fourth. So the way I think about this is, if you go back to like pre-2000, that to me was really sort of an era where you would see some disclosures. Some companies would talk to a degree about the sustainability implications of their corporate activities, but it was largely like an era of disclosure by exception to the rule, right? You know, you weren't required to say something, and a lot of companies just didn't say that much about the sustainability implications of their activities. But what you had is in the early 2000s, the development of an organization called GRI, the Global Reporting Initiative, and that, plus the global forces that were sort of behind the pressure for an organization like that to be created in the first place, that all led to, over the next 10 years, a dramatic shift in the focus on sustainability issues, where if you look sort of globally, by 2010, there were tens of thousands of companies around the world that were voluntarily producing sustainability reports. So this is sort of like the second era where it became sort of disclosure as the norm, right? If you're a large company, most large companies around the world were largely voluntarily producing sustainability reports. And then what you had around 2010 was kind of two related factors. One was the emergence of an investor focus on sustainability information, and I think partly then with that, much more regulatory scrutiny over it. You know, like if you're going to talk to your investors about this information, how do we know that we can sort of trust the information? And maybe we should have always been asking, how do we know we can trust it? But I think, you know, the capital markets are very accustomed to thinking about whether you can trust information or not. So over the from 2010 to 2020, this became a real focus again around the world. And then where we are now, I think, is that with the emergence of reporting mandates around the world, with a lot more focus on like, well, you're going to have to, maybe even provide assurance around this, put additional controls around it. I think with all of this, we're in sort of a new stage, which I sort of, I'll coin it like the reckoning, where it was one thing to say there's a lot that we'd like transparency on, and if companies are largely like voluntarily complying with that, people don't worry too much about the cost of that system. But once you start sort of imposing it, then there's, I think, a real look at the cost-benefit trade-off that we're sort of asking. And I would say different jurisdictions around the world are going to land in a different spot on that, but they are almost all, I think, sort of taking a look at that. And that's leading to like a bit of pullback or major pullback in different places. So I think that's like basically those four stages is I think where we've come from and where we've gotten to.
Thank you. This is a session both on sustainability accounting and sustainability tax. I know you are in tax. It's not very obvious to everybody what the role of tax in sustainability is. Back when we used to call sustainability ESG, I have seen this phrase somewhere, where is the T in ESG? So can you tell us something about tax and sustainability?
That's got a nice ring to it. Somebody should make a coffee mug, but like where's the T in ESG? A tea.
Well, I mean, I stole it from somewhere.
Is it a teacup or a coffee cup?
It's got to be a teacup, right?
A teacup. So, thank you so much for inviting me. It's great to be back in familiar surroundings, and I had a fabulous time teaching tax at Tulane before I moved to KPMG. So where's the T in sustainability? So if you parse sustainability into the three segments of E for environmental, S for social, and then G for governance, tax has a very clear role in all of the three pillars, if we can call it that. With respect to the environment, there is always, and we're going to spend quite a bit of time today talking about it, credits, grants, and incentives, right? So there are financial instruments in the form of tax credits to incentivize public, both companies as well as individual taxpayers, to adopt a more sustainable approach to life. So if you are a big corporation, if you put solar panels on your company's rooftops, there's a tax credit for that. That also applies to individual households. If you put a rooftop solar on your house, you're going to get a tax credit for that. If you are going to drive an electric vehicle, you would have gotten a credit if you bought it by September 30th of 2025. The new administration has done away with that. So there is small as well as large tax credits to encourage businesses and for the general good of the planet to adopt more sustainable practices. That's the carrot. You also have the stick. So you've got a plastics tax or you have a sugar tax to disincentivize companies and people from adopting actions that are going to be bad for the environment. So from an E perspective, you can use tax as a, I used to say this as a professor, tax is a behavior modification tool. Here's a carrot. If you do good, you get a star. And if you are doing something I don't want you to do, then I'm going to levy a tax on that. From a social perspective, from a sustainability area, again, the same things, right? If you are a business, there are lots of incentives for you to hire from certain populations. We have something called a work opportunity tax credit. And that, for example, allows companies to take a tax credit for hiring veterans or other groups of specifically identified population. If you hire from them, you get a tax credit. So that's another way for companies to give money back to the society that they are operating in. It's a symbiotic relationship. If you think about governance, there's two components to it. One, governance is really a mechanism of, are you doing what you've committed to do? So if you've committed to saying, I will reduce my emissions, my carbon emissions, I will plant more trees, I will be more green, I will conserve water, what have you done to make sure that that is getting done, right? So that is tax agnostic. It's just business principles. But the other component of governance goes back to what Jeff was just saying with respect to tax reporting. There's a big discussion on, is everybody paying their fair share of taxes, especially for businesses? And I want to piggyback with what Jeff just said here with respect to reporting and transparency. So to adopt your same timeline, right? So way back before the GRI and the B team, you got tax returns so secretive, right? We can't get anybody's tax returns in public. Then there was a little bit of pivoting to, we need to have more disclosure and transparency around taxes because, taxes are important for society. The United Nations has these 17 goals that they've said in order to fund these, from water to education, eradicating poverty, governments need tax revenue for the betterment of society. And that brought on the discussion of, hey, are you paying enough taxes? Should you be paying more? Et cetera, et cetera. So now with transparency, it's interesting that you pointed out that jurisdictionally there's going to be diverse adoption of reporting requirements. I feel that for tax, however, there's a little bit more of a global standardization. The European Union is way out in front of everybody. They have public country-by-country disclosures coming out right now. So if you're operating in the EU, they've got a stipulation of this is what you need to disclose. Australia has, again, a standardized version of those disclosures. So there's a little bit more standardization, I feel, maybe on taxes with respect to transparency and reporting. Bottom line, tax and sustainability, two ways to think about it. Reporting, there's more of a spotlight on tax reporting, but credits, grants, and incentives are a huge factor in getting the sustainability journey moving forward.
So can I summarize this, what you just said there? Because when you pose this as like, where's the T in ESG? It's kind of clever because like, oh, it sounds like the T's missing, but it's not, right? That's sort of the punchline there. But if you say it in terms of like, where's the T, in sustainability, actually there's several. Right? So like there's T's all over the place, and it comes out to your 2 points in the ability part, like it's the driver of it. It's like it changes the incentives, and it's there in the accountability part of it as well, because you want transparency on some of these things. Did you do what you said? So
yeah.
I love
there
that.
There are 2 T's of sustainability.
Yeah, there are. You said there are two. So there you go.
That's a perfect summary. So this is a question for both of you. We are in Louisiana, and this is the Tulane Energy Forum. So would you mind shining a spotlight on sustainability accounting and sustainability tax, respectively, as it pertains specifically to energy companies? Jeff, you first.
Sure. You can't shine a light on anything without energy, in a sense, and so so everything is energy. If you look at the energy industry, it has evolved a lot in recent years, and a lot of that is because of taxes, but it's also new technology, the other T in sustainability, and so there are, when you think of an energy company and how it generates energy, how it distributes that, how it whether it competes in a regulated or an unregulated, and oftentimes in both kinds of markets, there are lots of issues that are going to arise, and to understand the differences between different energy companies, if you really need transparency on some of like the core issues. So if you take a look at what's in the ISSB uses SASB standards, industry-based standards for disclosure. So there are standards for an energy company, and a lot of them, as you might expect, are around environmental issues. The majority of them are probably around environmental issues, thinking about emissions, like greenhouse gas emissions, but also air quality, reliance on water and managing that. But then there are going to be quite a few of more like the people issues as well. So worker safety is going to be often top of mind for energy companies. Thinking about your customers and the fact that, again, like whether you're in a regulated or an unregulated market, that will create a different relationship with your customers. But that still is going to raise issues. It could be around affordability of energy, and again, like probably thinking through different lenses if you're in a sort of a monopoly or you're operating in an unregulated environment. So a lot of issues there, and then many of these sort of intersect as you start to think about what sort of new technologies are you relying on, and what sort of happens in your value chain as well, because no company operates in isolation. So where are you sourcing your oil, gas, coal, or is it are you working from wind and solar or geothermal or nuclear, and while those might be more renewable, they also don't come without some sort of cost and inputs as well. So so lots of issues all throughout the value chain. But again, climate would be one of the major drivers of just the environmental side, I would say, not the only part of that. And just quickly, if you were to think about, look at what do companies talk about, I would say many companies these days in their regulatory filings talk about climate-related issues. And in fact, I saw recent data on that showed of the S&P 500, almost every company is talking about climate somewhere in its 10K right now, of the largest U.S. companies. But energy companies, that's particularly pronounced. And I was just looking at a Texas company, CenterPoint Energy. They have at least 50 references to the word climate throughout their 10K. And so this is front and center of the way that they think about their business, to what they think the risks and the opportunities are. So that's probably the biggest driver, but it's not the only one.
Anu?
Sure. I think one common theme that Jeff and I are both seeing, you can't put the genie back in the bottle, right? Sustainability is now front and center, so you have to just embrace it and then figure out how do you move that forward. So there's a little bit of, I would say, pendulum swings. The various COPs had commitments that folks made to reducing their Scope 1, Scope 2, Scope 3 emissions, and how are they going to demonstrate being green. It has become a way to attract new talent, right? To make sure that, okay, you're going to go work for a company that is at the front end of being sustainable. And from a day-to-day business perspective, and you start making decisions, a lot of these energy or sustainability programs are very expensive to implement. It sounds fabulous for a company to be able to say, we, as part of our day-to-day operations, we emit carbon dioxide or carbon monoxide into the atmosphere. There is now new technology that's available that we can sequester the carbon. So instead of putting it out into the atmosphere, we can take it, we can capture it, we can put it underground. You're not going to get any diamonds anytime soon. It's going to take, a few millennia before that comes anywhere there. But instead of polluting the environment, let's go ahead and sequester. It sounds like a fabulous idea, but it is so prohibitively expensive to do that. And it's not something that you can decide and say, CCUS. There's lots of conversations at this forum as well about carbon sequestration. Louisiana is a hub. They're still testing to make sure that it's safe enough to sequester carbon. That's where tax credits and incentives play a huge role, so that you're able to say, as a society, the government being a representation of the society, we'll meet you maybe 10%, 15% of the way, so that it's a joint effort in order to undertake some of these efforts. And I think that's a big role that credits and grants and incentives are playing. And as rules change, I mean, I don't know if there's other folks in the tax world, but Jeff, you and I were talking about how every few years the rules are constantly changing, and sometimes the financials will not pencil out but for the availability of having credits, grants, and incentives to be able to fund these projects. So it's a symbiotic relationship. You can't have one without the other, and the role of CGI, credits, grants, and incentives in moving sustainability forward for energy companies, I think it's going to be critical that they're able to access that.
So just the scale itself in energy companies is so large that it makes it very salient.
It does, but to go back to the reporting requirements, right? The energy companies are no longer purely just US-based. So many of them are playing in the global landscape. So what happens in Europe, reporting requirements in Europe, reporting requirements in Australia, will impact the US energy firms as well, either because they have their own presence there, or they are a supplier in the value chain, and somebody that they're working with wants to see those kinds of documentation. So again, it's an interwoven playing landscape.
Maybe just a couple points though on the, sometimes things are prohibitively expensive. The way I sort of think about this is like, oftentimes things are prohibitively expensive until they are not, right? And why might they not be? The cost of producing any prototype, if you ever watch Shark Tank and they get any of the questions around like, how much does this cost to make? There's always like, well, the cost to make this was prohibitively expensive. Like you can't get someone to pay that amount for it. But they think like, in production at scale, right? And so how do we get there? And a big part of like how we get there is that there has to be like private markets can, capitalism can often get us there, but it does take a belief that like there's going to be, like a reason to get there in a sense. And so, you can, taxes can play a really important driver in reducing marginal costs now to start to get people to develop technologies, and then they compete on that, and then we see prices drop dramatically. We've seen with the price of producing solar that has dramatically outpaced what the expectations were in terms of like the price drop there. So, and the other thing is like, can we also get out of the way? I live in Texas, and it remains, I believe, much easier to get permitting to drill an oil well or for gas than it does to get permitting to put out like solar or winds, right? And this is a this affects the cost of something, and it is fixable potentially. It depends on like where the sort of the social and political will is on it.
Thanks. Anu, you alluded to this international effect, so I wanted to get to that. I'll start with Jeff. Our audience is primarily US companies, but we do operate on a global stage. So how are US companies impacted by international sustainability accounting issues? Because as I understand it, Europe, Australia, and all, there appears to be way more spine there towards sustainability.
So I'd say like if you're a multinational organization, then you face direct transparency and reporting issues. So you got to do accounting for your sustainability issues because you are going to be subject to some set of rules. And just very quickly on that, there are basically two sets of international rules at the moment. You have the organization I'm associated with, the International Sustainability Standards Board. Our standards are currently already or in the process of being considered to be used in countries, in I think it's 37 countries around the world right now, which is capturing about 40% of the global market cap, but 80% ex-US. And so if you have operations in one of those countries, then you're likely going to be subject to needing to comply with international sustainability standards. But also, if you have operations in Europe, they have a law called the CSRD, the Corporate Sustainability Reporting Directive, and that has created their own EU block-specific rules called the ESRS, European Sustainability Reporting Standards, but you can just think of it as like, method number 2. And so that is required for European companies, but also companies that have meet the threshold for disclosure if they have operations in Europe. And that is understood to affect potentially like 3,000 or so US companies, I think.
Yep.
Although they are also, as part of like the reckoning, they are going through something called the omnibus legislation and taking a second look at all of that. But so, as a multinational, you're going to probably have some direct transparency requirements there. If you are operating, solely in the U.S., my guess is you may still have business partners that operate in other jurisdictions, and so, to the extent that you have suppliers that are in Canada or in Mexico or Brazil or other places, then those countries also are going to have their companies meeting certain sustainability disclosure requirements, and so you might in the value chain get asks from your business partners like, we'll buy this product from you, but we need to know more about it so that we can meet our so we can say something about the products that we're ultimately selling.
Anu, you alluded to the international setting. Does this happen in tax also?
Most definitely. And I think some other changes that we're also seeing with respect to activist investors now joining the board of a lot of the public companies. A few years ago, tax transparency would not even have made it to an agenda item on a board, annual board meeting. I think in the last couple of years, prior to this administration, in 23, 24 time period, there were quite a few of your big tech companies that actually, it was an agenda item. It didn't pass. But there was enough votes for it to become an agenda item during the annual general body board meeting for there to be a discussion on whether this Fortune, talking 25, Fortune top 25 company should actually undertake a public tax transparency disclosure method. So that's how much the pendulum has swung. And again, because we are in a supremely global environment and you've got the reporting requirements across the globe, whether you are directly impacted so the big energy companies, you have the footprint over there, you'll be required to publish the transparency reports or other reporting requirements and abide by them. The smaller companies, if you're a supplier and you're working with some of these bigger businesses, then you would have to follow their requirements as a supplier and then be required to put out the publication. So that's one thing. And then secondly, on kind of going back to the other T, which is the credits, grants, and incentives part, the United States is not the only jurisdiction that's providing these grants. Grants, credits, and incentives are available on a global basis. So depending on where you're operating, you would have access to similar grants and incentives in the local jurisdictions as well. So it's double dipping, so to speak.
No, I did read somewhere that, for example, you could claim credits because you are supporting a plantation in Chile or something like that. So something like that can happen?
That would be a renewable energy credit, which is a different credit, not a tax credit.
Oh, it's not a tax credit. Okay, you can see that though I'm an accounting professor, tax has always been on the dark side for me. But thanks. So anyway, you alluded to this a couple of times, which is some things have gone away now, the administration has changed. So let me come to the big elephant in the room. There are political changes in Washington. So, we know companies have spent resources in prepping and creating sustainability reports. Jeff, we even have local companies in New Orleans that specialize in creating these sustainability reports. So with the winds blowing from Washington, how sustainable is sustainability reporting?
Well, the way I think about this is that the issues are going to exist whether we pay attention to them or not. So whether there's going to be a change in the environment and what that change will be, things in nature will happen whether or not there's some accounting for it. Now, I believe there's like a way that, what you measure gets managed at the end of the day, but the stopping if you don't look at something, that's not necessarily going to make it go away. The safety of your employees, whether or not you've got a good relationship with your customers, these things exist, and they'll make their way into companies' financial statements and into global GDP, regardless of whether or not we have any transparency over them, right? Like the effects will still happen. The question is like, to what degree, at what speed, and in what direction, right? So and that will all come down to what extent do we manage these issues, right? And so, will a company manage its sustainability risks and opportunities, and will it manage them well? Mm-hmm. It's a great question, and a lot of it's going to depend on what scrutiny there is. If the capital markets are paying attention to these issues, then companies are more likely to manage them. And investors are more likely to pay attention to them if they're actually getting information that is relevant and that they can use. And there's empirical evidence that backs that up. And also, investors are more likely to think that the information is going to be relevant if they think that that employees will care about some of the ways in which they engage with the company, right? Like, how safe is it? To what extent do they want to go to work? Do they want to continue to stay and work? Do they want to be engaged at work? To what extent do customers feel like they're getting the products and services that they want to keep coming back for? And to what extent do local community members feel that they want to be supportive of companies that operate in their community and pay their, contribute to the community through taxes, right? That would be one of the ways, and offer good jobs. These are things that if nobody cares about them, if no stakeholder cares about them, investors aren't going to care about them, managers aren't going to care about them. Things will still happen, and they'll still make their way into the financial outcomes that will happen, but we won't see those things coming. Yeah. So accounting is there to help shine a light on it, and we don't shine a light in the accounting world just for the sake of saying, so that we can say you were asked to do it. I'm not thinking of transparency as a substitute for policy making, which I think it often is. If there's not political will to require companies to behave in a particular way, we often say can we at least ask them to sort of say it somewhere, right? That's sort of like a cop-out on real regulation, if that's what you think you should be doing. But in an accounting world, what we're really thinking about is information to be used by somebody, to run the company, to invest in the company, or for regulators who have oversight to sort of understand the company. So is sustainability reporting sustainable in a sense? It's all going to depend on whether there's a user of it. If we can't produce information that somebody wants to use, then there is going to be no demand for it. To the question of how does periods of deregulation affect this, my experience has been when there's more deregulation, the role of accounting becomes more important because you have more variation in what companies might do. You can think about it this way. If you're thinking about the importance of how good your drivers are, whether you're a ride-sharing service or a taxi or a trucking company, if you need good drivers, you need them to be safe, rested, they can't fall asleep, they can't be drunk, they can't be reckless. You need good drivers. But if you regulate that away by having autonomous drivers, right, then all those vehicles start to act in a way that's actually pretty similar. There's a lot less variation. So you don't need to ask as many questions about how do you hire your drivers? Yeah. So in periods of deregulation, the importance of information actually goes up in a way that I think is a bit counterintuitive.
That's a wonderful answer,
yeah,
actually.
I know, that's very astute, yeah.
That's a wonderful answer because it takes me back to my accounting PhD days. We learned that accounting is a self-evolved discipline. It is not that someone mandated that there be accounting. FASB and all these accounting standard boards are only, 50 years old. APB is 70 years old. But accounting has existed for, millennia. back when I was a Yale professor, my neighbor was an anthropology professor, and he showed that accounting existed in the Sumerian civilization. So,
But not because it's like relates to a hard science, like one of the physical sciences. This is not about discovering the atomic weight.
Because of the need.
It is a social science, and that's why there's been a demand for it for millennia, is because it serves society through communication.
Right.
And so it's got to do that and do that well.
That's a wonderful answer.
That is fabulous, yeah.
But I know this is even more relevant for you because companies take up projects based on tax credits and incentives. I mean, suddenly there is a political change in Washington, and then some projects that you had before are no longer viable. So are tax incentives for sustainability enduring? Give us your answer for that.
Yes and no.
Okay.
So unfortunately, sometimes the whole credits and incentive scheme has a flavor of the month feeling to it. But at other times, there's always going to be something that is available. So oftentimes when we work with our clients, we'll say, if you're going to be spending $1 on a particular project, we can find you something so that your bogey comes down to 90 cents. And what that something is depends on what's available. So it's like going to a buffet and you think you might get ice cream, but there's only carrot cake. So it's not that you're not going to get dessert. You may have to settle for carrot cake as opposed to ice cream. So it's lunchtime, right? So hence the dessert analogy. But that said, you're always going to have some version of a credit or an incentive. It's just the nature of business. Again, it goes back to the whole carrot and stick that we started off with. So I think something's going to be there.
But I think one of the things you pointed out is like this flavor of the month or day or week. One of the challenges for companies really is a real roadblock is when there's uncertainty about what's coming, right? And sometimes, I bet there are situations where if the tax incentive is low, it might still make sense to do something. But if you're not sure whether it's going to be high or low, you're not exactly sure what to do. And so you can still find that there's a pause in progress on something that it is economically viable to pursue because of the uncertainty between these swings.
Right.
And that happened last year when when there was a lot of uncertainty about what was going to happen with the administration, a lot of projects were pencils down. So if either they accelerated it to make sure that they got it done or over certain milestones so that they were grandfathered into the previous regime and you were guaranteed that the credit would be applicable based on the old rules, or if you hadn't started, you were like, I'm going to wait and see what happens. So those are the challenges that I think tax departments, but it also goes to why tax needs to be part of the conversation within the business. So as sustainability departments are putting out goals, right? As finance departments are thinking how they're going to fund it, tax is always, should be ideally, part of, you walk alongside everybody and you're part of the conversation so that you do add the value that you need to make the decisions that are appropriate for the financial health.
In some ways, it's like tariffs, Tell me a regime and stick to it. Don't keep going back and forth because that's what leads to this uncertainty.
Yeah. So,
I don't know how much of an influence we have over Washington, but, at least we realize what companies are looking at. They are looking for stability. And in that sense, I think the credits and incentives part does get affected.
yes.
Yeah.
So.
Well, I noticed that we have about 5.5 minutes left, and the panel did say that they were ready to take questions. So if there are any questions, please feel free to read them, and both are experts,
Yes, first question. What are your thoughts or opinions on companies writing off the purchase of voluntary carbon offsets?
Take that?
It's a very specific question. Who wants to take that, I think?
So, I think one of the issues is if you're asking for information about the emissions that a company is associated with, whether that's their direct emissions or indirect emissions that they're associated with from other businesses' operations, then I think it's going to be important to think about in what ways would a credit or an offset matter, and sometimes it does matter, because what you're looking for is you're trying to find a way to finance other kinds of activities that you're not going to directly finance through, say government and taxes. And so this could be one way that you could do it, is by finding ways to create partnerships, because my business emits some emissions, but yours is growing trees, and so let's if I can help you grow more trees, then maybe there's a way that can because we can't get a government for whatever reason to directly support more natural carbon sequestration. From an accounting perspective, the real challenge often is, if that's the intent, you need to make sure that the things that you're measuring are going to be useful for ultimate decision making around that. And I think a lot of the criticism on voluntary carbon credits is that that the types of attributes that you could attach credits to vastly outnumber the activities, and so it ends up being a lot of nonsense, maybe not as meaningful as we would hope that it would be. It's a little bit different when the government grants credits as part of like a mandatory scheme, and so says this is essentially how many units the entire system can emit, and so if you don't have the rights, you don't have the certificates for that, then you got to pay, right? Yeah. And so that's a very different system. Yeah. There is a lot of work to try to improve the accounting to come up with more credible measures of the offsets and credits, and I think, but again, like it should still, quality of information, and also think about and what is the goal? Because make sure it's we don't need accuracy for accuracy's sake. We need it to sort of fit the purpose it's intended to serve.
That's a great answer.
How does KPMG navigate the works tax credits that are focused on specific communities, given the current governmental changes?
Okay, so how do we navigate? When we work with a client, we try to understand what their global operations are. Or within the United States, what is their local footprint? And we try to identify. Let me take one step back again, thinking back to my tax professor days. You don't let the tax tail wag the dog, right? You never take a decision because that's the best tax answer, but you never take a business decision without understanding the tax consequences of doing something. So when we work with clients, and if they say, hey, we would like to set up an operation in New Orleans, in Louisiana, then we would sit with them to say, that's what you would like to do. These are the credits, grants, and incentives that are place-based incentives that are available here. If you are looking at other areas, these are some of the other incentives that are available to the other areas as well. Then ultimately, the client then is able to take an educated decision on what makes the best business decision to where to locate that particular operation. So it's not one where tax drives the conversation. Tax is a value driver and adds value in the decision-making process.
Okay. Given the changes in Congress regarding tax credits, how has the pace of issuance slowed regarding ITC applications and the issuance of registration numbers?
So the issuance of registration numbers is definitely a very big challenge, not directly because of the credits slowing down, but with respect to changes that have happened at the Internal Revenue Service and loss of personnel, and then other changes that they have made in there. So what we are telling clients is to make sure that as soon as they're getting ready for tax compliance, to start registering their projects so that they've given themselves as much time as possible to go get the actual credit. But also there is going to be, I expect, a little bit more scrutiny and audit on projects, especially as more and more tax credits get applied for, that they should be prepared for additional scrutiny. So again, our advice to clients as part of that compliance and due diligence process is document some more, and make sure that any documentation you need from suppliers to support your domestic content requirement or wage requirements, that they are very cleanly buttoned up, and just making sure that you need to be prepared for a little bit more pushback potentially.
All right. I think the red light is blinking here. That indicates that we are out of time. That's why the questions have ended. Thank you very much, and thank you so much to our experts for taking the time to be with us today. Thank you. Thank you so much.
Thank you for joining us for this session. Our next session in this space will be Community-Driven Strategies to Expand Reliable Energy Access, and that'll start at 3:10 this afternoon. Thank you.